Welcome to my channel, Givonians. So as you may have heard, Giva has filed a preliminary proxy statement which is used when a shareholder vote is required. A special shareholder meeting will be held with the purpose to increase the total numbers of authorized shares of common stock from 250 million to 500 million shares. This special meeting will be held sometime next year. The board unanimously recommends a vote for approval of the amendment. An approval is crucial. If the stockholders fail to approve the share amendment, Giva may not be able to enter into transactions with Chevron and ADM. Moreover, the company would severely be hindered in its ability to pursue additional similar strategic transactions with other third parties or other accretive opportunities. So a disapproval could jeopardize the entire deal with ADM and Chevron. Giva would also have to reevaluate their ambitions to grow bigger sooner, and their vision to produce 1 billion gallons per year by 2030 could be stopped in its tracks. This would be absolutely devastating for Giva's business development and future growth. Giva recently entered a letter of intent with Chevron, which contemplates Chevron co-investing in one or more net zero plants, as well as purchasing approximately 150 million gallons per year of offtake.
So for example, if it was, they took 100% of the offtake of 3 of the net zero style plants, then they would put in the equity for those plants. Or we have the right to take the majority of the offtake and sell it to somebody else, in which case they would get 49%. So then it might be that they invest in 6 plants. That's what we're talking about here with them, and we have a lot of work to do to sort it out, exactly the details of what are we really going to do and how are we going to do it in detail, and we project we would have those deals finalized in May of next year.
The MOU with ADM regards a potential strategic collaboration to convert about 900 million gallons of ethanol into 500 million gallons of SAF.
So now we're really getting focused on how the heck do we grow much faster. The ADM discussion is part of that. They have 900 million gallons of ethanol that they talked about. That would produce about 500 million gallons of hydrocarbons. Well, that's a pretty good chunk along the way.
The market is starting to see Giva's enormous potential, and the progress the company has made this year is starting to get investors' attention. There's no doubt that Giva would have a very bright future if these deals were to be secured. So why would the stockholders vote against this amendment and risk jeopardizing business with Chevron and ADM? Well, here's why.
Dilution refers to the reduction in the percentage equity ownership of a company due to additional equity being issued to other owners. Dilution can occur for a number of reasons. For instance, a company may have issued convertible bonds, warrants, or options. Any exercise of those conversion rights will increase the number of shares outstanding, thus diluting the ownership interest of existing shareholders. Or a publicly traded company may issue additional shares to the public in order to fund a capital expenditure. For a publicly traded company, dilution caused by the issue of new shares results in a corresponding drop in the market price of the shares.
This is Richard Coffin, who runs the YouTube channel The Plain Bagel, and this is his view on dilution.
So, share dilution sounds like a pretty big ripoff at this point. A company essentially raises money at the investor's expense. In some cases, however, share dilution may allow your company to materially improve its business, and the pain caused by the share dilution may be offset by the improved profitability of the firm. Going back to our example, imagine that the company issues the additional 2.5 million shares, but the money they raise from the issuance is used to buy a company with intellectual property that is expected to greatly improve the company's margins. And the next year, they see their earnings jump to 87.5 million. In this case, your earnings per share will increase from $5 to $7, a pretty solid return. So even though your percentage claim over the company's earnings has gone down, the size of the profit pie as a whole has gone up to compensate for this, and your sliver ends up being worth more. So if a company can achieve a high enough return on equity with the money they receive from a share issuance, the impact of share dilution may be offset. So if a company doesn't have a meaningful strategy for improving operations with the money raised, then they are essentially destroying shareholder value. So share dilution can sometimes be a means to a positive end, but it's something that investors need to scrutinize. After all, if a company wants to raise money at your expense, they better have a good argument for it.
In my honest opinion, Giva has very persuasive arguments. The board believes this issuance is necessary for the company's ability to raise capital and secure new strategic and financial partners in order to maximize the potential value of the company's business plans. More importantly, any delay or failure to secure approval could prevent the company from entering into certain strategic transactions and could also have a material adverse effect on the company's business, financial condition, and the share price as well. A disapproval of the amendment could, in a worst-case scenario, lead to both Chevron and ADM taking their deals off the table and their money elsewhere. Taking into account everything Jiva has managed to achieve so far, think of all the progress they've made, their pipeline of offtake agreements, and the increased market demand for SAF, along with the political agenda.
The Build Back Better bill is passed.
Jiva is in a position to revolutionize the industry.
Well, we are entering a very exciting time because what's happened is that there's been an acceleration of interest, particularly in jet fuel, and I think we can accelerate things. I do believe so. You know, as we're thinking about how to get to that 1 billion gallons, that's a fun problem to work on because, by God, we can change things for real. Like, no screwing around and get on with it. Obviously, we'd have to have the capital for it. I think we should be, partnering, JVing, and of course that we got to figure out all the business models and how to do it and all the rest. But so it's about making sure that the customers will be there, signing them up, showing that we can go build for that demand. And it's a tug of war kind of a game, where you gotta, is it going to really be there? How will you do it? And then, well, yeah, we can do it. You're going to buy it. It's this back and forth all the time. And it's getting interesting because now I can show people and convince them it's doable, which is even better.
Looking in the rearview mirror, Jiva's had a successful track record with its issuance of new shares. And even though it has had a negative effect on the share price in the short term, Jiva has managed to grow and increase the company's value.
You got to raise money because you're not supposed to go bankrupt. That's part of the game. But what we were able to do? We were successfully stay alive, advance the technology, build customer contracts, and get out of that hole and raise enough money so we can go build our plant, build our business. And we have the equity now on the balance sheet for our first big plant, Net Zero 1, and I have money to help with Net Zero 2 and Net Zero 3. And you know what? I have all the money to do development that we need too, plus invest in an RNG project. That's pretty miraculous, actually. And so only for people who are new to the story or really aren't paying attention would think otherwise.
Thanks for watching. If you like my videos, please hit the like button and subscribe to my channel. I promise to return soon with more due diligence on Jiva. And remember, I'm not a financial advisor, and this is for entertainment purposes only. And until next time, bye-bye.